Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, thanks for tuning in to Phil's Tax Hacks and Other Retirement Facts with Phil and myself talking investing, finance, and retirement. Once again, we've got an interesting conversation really over the next two podcasts. We're going to talk a lot about financial jargon, a lot of terms and things that we hear on the regular, and then we'll also kind of translate that into how it relates to your professional that you might be working with and what some of their jargon means and just kind of how it all, plays together. So hopefully you guys will enjoy all that stuff. And of course, Phil's here with me once again. What's going on, buddy? How you doing?
I am doing great. Yeah, and our industry does not lack jargon, that is for sure. So.
It doesn't disappoint in that category?
No, not at all. I think acronyms are going to be the next one beyond that, but all the different ways of shortening things. So.
Our last podcast, Phil, has been resonating pretty well about guessing in retirement, and so people hopefully are realizing, hey, guessing is not a good idea. We need to actually put some practice in here and get some things done. So we thought maybe jargon would be a good way to kind of go, to kind of bring up some things that you're going to be hearing if you've never worked with an advisor, or if you have and you just, some of the stuff's pretty basic, which I think most of us know, but it's always good for a refresher. But then there's some other things that people might not be comfortable with. So, but anyway, the all-time high for the Dow was at around 36,000. We dropped into territory that was considered correction. We got down to around 32. At the time we're taping this, it's back up to 35 and a half. It's almost back to the high. So Is it a bear? Is it a bull? What's the difference?
Yeah, and that's always the funny part is you never know until we get through it, and the fact that we're almost back to the high, that still doesn't mean that this was the start of a bear market, because until we get beyond it and it's, months out where you can see, okay, yeah, we hit the peak and now it's bottoming or whatever the case is.
Right.
That's why they're always, telling you, so to speak, in the rearview mirror, okay, this is when it started, here's when it ended. But yeah, so I mean, by definition, a bear market's that general decline in a market over a period of time, right? Usually 20% is kind of the key that they look at over at least a 2-month period. So it can't just be a quick drop because
it's
something
2 months.
Right
I
back up
thought it was
again.
2 quarters for some reason.
Well, 2 months, two periods. I mean, yeah, so probably 2 quarters. Yeah.
Oh, okay.
So a more extended drop, so not something that's just a quick drop and back up.
Yeah.
So even like the pandemic, I mean, there's all discussion on, was that really a bear market or not? It's kind of a short period of time. It was down and back pretty quick. So generally it's that more extended downturn in a market, so everyone goes from being, the investor optimism. Now they're starting to get fear, pessimism,
right.
Where should we be investing at this point? So,
well, and we're kind of obsessed with records. So I think one camp is like, well, if we haven't technically seen a bear market, then we're on a 12 or 13 year bull. Basically.
Yeah.
And that's kind of a record, if I'm not mistaken. So
it absolutely is.
We get usually kind of like obsessed with that,
Yeah, usually bull markets on the flip side, I mean, they're 8-10 years,
Yeah.
is the average. 8.5, I think, is the average out there. Yeah. So we've talked about that, and everyone's talked about that for years, that, this is the longest running bull,
right?
Which technically, I mean, it still is. We haven't, broken through for that extended period of time. We've had definite volatility, right?
Yes,
some downs, but.
Well, I'm going to stick with my Rocky analogy until this thing proves me wrong, because yet again, it's taken a bunch of punches to the face early in 22, and it seems to be getting back up again, in spite of our next topic, which is inflation. That's the next term I want you to just kind of give us a quick little synopsis on.
Sure. Well, I mean, generally that's, a progressive increase in prices of goods in the economy over time, right? So, but the real question is, okay, well, why does it happen? Why does it happen? And really it comes down to a lot of money chasing too few of goods, right? Yeah. So it's kind of a couple of pieces of money that gets played into here. Number one, the supply. So there's been an increase in supply of money,
right?
Which, I mean, we obviously saw that through the pandemic. I mean, there was a lot of money put into the economy to try to bring us back out of that quickly, and it did. But now we're seeing the other side of that is that money is out there chasing goods that aren't there, so that causes inflation.
I had someone tell me a great way to think about inflation. It was really simple. I don't think I've shared this before, but he said, if you got 10 apples and you got $10. Well, how much does
Yep.
each apple cost, right? Costs $1 each, right?
Sure.
So you influx a whole bunch of cash, like we did with the, with the stimulus and things. Now you got
Yep.
$14 and still 10 apples. So how much does each apple cost? $1.40, right?
Yep.
That's inflation. Now you take away, 3 of the apples. Now you only have 7 and you got $14. Now each apple costs $2, right? So you got more money, less product, inflation.
And and that's exactly what we've seen and kind of what spurred this on. I mean, generally it doesn't happen in this fashion this quickly, but we've had a lot of pieces play into it.
Right.
The other side of it is going to be that velocity of the money, meaning how many times does that dollar turn over? And we've seen a lot of that. Because I mean, if the money is just in the economy and no one's spending it, they're saving it. Well, it's really not going to cause inflation because it's in the bank. It's when that money gets out. We
kind of didn't see during the lockdowns because nobody was spending.
Yes, no one was spending. Right. So that's why, you might be thinking, well, wait a minute, this has been like 2 years. Why are we just now seeing this?
Yeah.
It's because people had the time, at that point to save it. They couldn't use it, couldn't spend it. Things were shut down. They couldn't go on vacation.
Or you just couldn't find the product.
Spend it a lot of times at home, you couldn't find the product, so now that things are opening up a little bit more, there's all this money, this surplus that's been accumulated that is all of a sudden starting to come into the economy and chase goods that the supply chains have been, cut down and compressed and not as many goods out there. So we're starting to see that inflation jump up.
Okay. So we've got the bear and the bull, then we go to the inflation, which we've been experiencing for sure. And then there's talk of the recession, Phil. At what point, so what does the term mean? And then at what point are we looking at it? And a lot of the conversation is around if the Fed continues to raise the rates. Now they've said, I think they've done 1/4 point so far in 22. I think they said 6 or 7 more maybe this year with another 2 or 3 next year. So maybe 10 different times. And some people, speculate that could put us into a recession. Explain that.
Right. And that's always that balancing act that the Fed's trying to play, because a recession is when economic activity starts to slow because people aren't spending, so you got a significant decline in, all the different segments of the market. So, the goods, the, income, employment, industrial production, everything, retail sales, that all starts to decline because people aren't spending.
Right.
And that's really the purpose of the Fed's raising money is they're trying to entice people to save it now versus spend it because we can, get more by investing it. So maybe we shouldn't save it, so that's generally the concept with the Fed's raising the interest rates is trying to slow the spending, that velocity.
You're curtailing the need to the borrowing want. People won't want to borrow it because it costs more to borrow.
Right. Borrow or to save, both sides of that equation. Yeah. So they're trying to slow down the spending by number one, making it cost more if you're going to borrow to do it, or making it more enticing to save.
If you save, right? Yeah,
and then versus just spending it. So
right. And now, so one of the things I heard in there was employment and company. So that's where the real, I guess, rubber meets the road in the whole thing, because while, for a lot of us, it's that, do we save some or whatever the case is, but really it's about the corporations and the hiring and so on and so forth that can happen with that type of thing.
Right. Yeah. And that's that longer term effect. It starts out with what you start to see, but then it ends up, corporations reacting like inflation today. Everyone's thinking, prices are going up, but that's not just for you, that's for the companies as well. So that's why their prices are going up. And eventually this starts to have the effect on the economy and things start to slow down. That's why I said it's a balancing act from the Fed standpoint, think of it almost like a brake, right? They're trying to put a brake on the spending, in the economy to slow it down because it heated up really quick from that inflationary standpoint. But yet they can't just slam on it because then it's going to throw us into the recession all of a sudden.
Right,
So that's a tough thing to do.
It's driving a sports car, right? It's driving a hot rod or whatever, and trying to make sure that you don't get too crazy, you don't go too
pump
fast.
The brakes, a little bit of gas back and forth.
Don't brake too hard or spin out.
Yeah, we have to go through these bull and these bear, the corrections, bring back the normal type of a market. Same thing with an economy. It's not healthy for an economy to go through either no inflation, or high inflation levels. You've got to go through these both sides of the equation, the inflation, deflation, get
It's
into
the
the
checks and
recession,
balances of the whole
market
system.
growth. I mean, it's just what, pros and cons, both sides of that yin and yang, whatever you want to look at, the way the economy, the markets work.
Yeah.
We go through these cycles. It's something that's nothing new. Inflation, just like the market, something that, all of a sudden you're thinking, what in the world happened? We haven't had this in 40 years. Well, you're right.
Yeah, this kind, right, exactly.
We've gotten used to this, nominal 2%, 2.5% type of inflation. And I mean, that's not real either.
We can only
you have to look at that long term.
Yeah, we can only distort things for so long before they have to kind of reset themselves. Natural balance, whatever you want to call it. Same thing with nature. So you got the inflation, then there's a talk of the recession, which you mentioned now, volatility. So these two conversations tend to make, and granted, the whole European thing is obviously adding to the volatility, but these two other terms lead to the term of volatility, which is what?
Yeah. So, I mean, volatility, the way I think of it is if you think of kind of that average return, right? Draw a line of that average return. Volatility then is the returns above and below that line, so the swings up and above and below that line. So the bigger the swing, the more the volatility.
Right.
So something that's low volatility is going to hover right around that line, but it's not going to be very far above or below it at any point in time.
Yeah.
So it's the ups and downs, the roller coasters, if you want to think of it that way, of, how big those ups and downs are. So
I thought this was kind of an interesting analogy for volatility. You take your dog for a walk on a leash and you've got him next to you and he'll walk a straight line with you. But if you go to the same area and walk and you take him off the leash, he's zigzagging all over the place.
All over the place.
If you're on the path and the path is that line you were just talking about, he's over here, he's over there, or she, whatever the case is, right? So that's kind of that volatility.
Back and forth.
So I thought that was an interesting way to think about that, especially for all those, everybody loves dogs, right? So
you got to bring the dog into the equation. So
you got to bring a dog into it. So that's volatility for you. So then risk tolerance then becomes the question from the volatility, because that's what we saw in January and February and early March, people going,
correct,
I can't handle this volatility, Phil.
Right. Yeah, and that's really risk tolerance. Then is how much of that are you comfortable with? What does that look like for you? Everyone likes the swing above the line. I mean, you give me as much of that as you can, right? Mm-hmm. But what they don't like is the swing below the line. So it's what are you comfortable with? That's what you have to answer and invest according to your risk, because you don't want to be in a scenario that, like I said, everyone likes the swing above. We've gotten used to these highs, but for that you have to be comfortable with the swing below too.
And if not, that's when we start taking it off the table, right?
And that's and I tell my clients this all the time when we're going through this discussion, you've got to get here, you've got to be comfortable with here. And you don't want to decide when you're down there that I'm not comfortable with that, because now it's the wrong time to make that decision. So let's have that discussion right now. This is, everyone wants I want a 10% return. Okay, well, that's fine. You got to be comfortable with maybe losing, 20%. Are you okay with that?
Yeah.
Well, no, then this probably isn't realistic. It just doesn't exist. That's not how things work.
And then you got to adjust your risk tolerance with your professional, with your advisor.
Right. And make sure you're adjusting and having that discussion ahead of time. And it's just human nature. When markets are going up, everyone's comfortable. Oh, I want some more risk. I want some more, But then when things get volatile, we naturally like to pull our risk back, but you've got to be very careful with that. And that's where your advisor can help.
Yeah, exactly.
Is to have that discussion with you ahead of time. Walk through here. I know you want more upside, but let's talk that through. This is what, to get that, you got to be comfortable with this.
Yeah, you get to be that sounding board. Talk me off the ledge, Phil, because I feel like I'm going to do something crazy, or I'm freaking out, or whatever the case might be. So,
I bring up often when I'm talking about that. Everybody's like, "Oh, but the S&P is up, 20% last year." I said, "That's great. Are you comfortable losing 50?" Well, no.
No.
Okay. Well, then why are we even talking about the S&P then? Because that's what it has done. And I mean, at some point, very likely could do again. Who knows? I mean, it goes through huge swings like this. It's just part of investing.
I don't remember the exact numbers, but for last year, 21, let's just say the S&P was up 40% at the end of the year. I don't remember. It was high. I don't think it was that high.
Yeah.
Either way,
I don't think it was that. I think it's in the upper 20s, but yeah.
But let's just call it 40 for the sake of the argument.
Yeah.
So, and people will often say, well, I didn't get 40, so I should
Right.
fire my advisor. They're doing something wrong. It's like, no, ask the question, how were you weighted? Because if you said to
Right.
your advisor, I don't want to take a lot of risk, then they have you positioned to where you are not going to get all of that 40. You're only going to get a portion of it. Is that kind of accurate?
Absolutely. And the other piece of it too is we're going to wait on a rabbit hole with this, but I mean, the S&P really isn't a good representation of the market, right? I mean,
But
if
just
you
in
really
general,
get into
right?
it,
Yeah.
because right. But yeah, in general, if you look at the markets, I mean, yeah, that you can't just look at a market, right?
Right.
Like I said, everyone wants the upside, no one wants the downside, but
Yeah.
it just doesn't work that way.
Yeah, whether it's the Dow or any index that you
any of
use,
the index,
if
right?
we hear on the news that it finished off the year at 30% and you go digging into your statements and go, well, I only made 18, my advisor's doing something wrong. Before you
Right.
go to that, you jump off that cliff, just make sure you figure out, what did you tell them? Did you tell them, I don't want to have a lot at risk? That may
Right. What
play
were
a
you comfortable
factor.
with on the downside?
That may play a
So,
factor into that. Okay. So let's see if we
yep.
can get to a few more of these here. So
Sure.
all of that leads us into something like dollar cost averaging, because then you may hear your advisor say, well, we need to be dollar cost averaging. So what is that?
Dollar cost averaging really, it helps you kind of level out that volatility.
Okay.
I mean, the challenge always is when you're investing is what's the right time. Everyone wants to buy in at the bottom, but I mean, that doesn't happen very often, right? So what do you sit on the sidelines forever waiting for that and then jump in?
Right.
Well, now you missed a lot of the upside. So I mean, dollar cost averaging is a way of taking that volatility and kind of smoothing it out from your investment.
And we do that over time, right?
You're putting it in over time.
Yeah.
And I mean, there's pros and cons there because I mean, to do that, now you've got to sit on the sidelines and, hindsight, I can tell you exactly what the right decision would have been. But, if we did that and the markets were rising, you're going to say, well, yeah, but we missed out on all this upside. But if we did that and markets dropped, well, now that would worked a lot better because if we would have put it up here all in at the peak, versus down here. So
Phil, is that like selling off the dogs, maybe taking some winnings off the table and then repositioning and buying some things at a when they're on sale? Is that, or is that tax?
No, I mean, that's going to be more like tax loss harvesting or rebalancing, when you're rebalancing a portfolio, bringing it back into what your allocation is. Dollar cost averaging was really more when you put money in.
Okay. All right.
I mean, by nature, when you're pputting money into a 401k out of your paycheck, you're naturally dollar cost averaging into a market because every paycheck money's going in.
Gotcha.
So
okay.
I mean, as you put the money in, it kind of went in on that average price over time. You didn't get the high with everything. You didn't get the low with everything. You got that average cost.
You got the average.
So
okay. Makes sense. It's right there in the title, average. All right. So how about the difference between bonds and stocks? I think most of us got this, but just give us a quick one.
Yeah. I mean, at a high level, basically, it's your relationship to the company. You own it or you're a lender to it, right? So a bond, you're lending the money to the company. A stock, you own a piece of the equity, so to speak, on the balance sheet. Not to get too deep in the accounting of it, but you actually own part of the company.
Right.
And it's, capital stack, if you want to think of it that way. And there's risk on both sides. I mean, the bondholders have less risk, but less upside too. Less risk because if things go south, they get paid first, right? So if a company's going bankrupt, bondholders are going to get paid off first. The stockholders get whatever's left. But on the flip side, if things are going well with a company, bondholders only get what the bond says, so their principal plus whatever interest, the stockholder has the potential of getting more.
And so the interest rate and the feds are going to change that whole bond equation.
Yeah, exactly. So the bond side of it changes the whole picture, with where interest rates are potentially heading now. So you got to be very careful with
and buying
bonds. Generally are a less volatile,
right?
More conservative investment in general,
right?
But there's more risk in a bond today than there has been in a lot of years.
Well, we typically hear people. That's that old mentality of saying, well, go to bonds when you get older because they're safer. And that used to be the case a long time ago, your traditional 60-40, if you will. But that's something where, again, now it's a little more risky. And so there's going to be a lot of interesting stuff with the bonds over the rest of this year if the Fed starts ticking up. Because if you've bought a bond at one rate and somebody can buy a bond with a higher interest rate, you've got a dog now, right? Basically.
Right. They're not going to pay you face value for your bond anymore because they can take that money and go get the higher interest rate. So you're going to have a discount, a loss on your bond. So, yeah.
So definitely got something to be aware of the differences there. Differences between ETFs, mutual funds, index funds, target date funds. There's a lot in there. So let's start with what's an ETF?
Yeah. Yeah. So just a high level ETF mutual fund. So, I mean, an ETF is, think of it almost like a fixed basket of whatever the underlying holdings are.
Mm-hmm.
So there's not money coming in and out of an ETF on a daily basis. I mean, it's a fixed basket. So it trades just like a stock. So you can get that intraday pricing. You want to buy it right now, market's open, whatever the price is, just like a stock, you get it.
Right.
A mutual fund, on the other hand, is a pooled investment vehicle that, as investors put money in, this pool is going to expand and contract every day as money comes in and goes out, inflows and outflows. And because of that, we don't know what the price is until the end of the day. That's just how mutual funds work, is at the end of the day, they value everything that's in the fund by the number of shares. There's, roughly what your value is. It's a little more complex than that, but generally that net asset value concept, I mean, that's where it comes into play. So ETFs are more what I would call an unmanaged basket. It's fixed, and from our manager standpoint, we use ETFs because we know exactly what it is. We're buying this segment of a market. We're getting a broad exposure into that segment of a market. Mutual funds can be managed or not, but they're generally, the thought in a mutual fund is it's more managed. So you've got you're in whatever segment of the market, and you've got a manager running that strategy, picking the underlying investments and changing them potentially.
Mm-hmm.
And there's pros and cons to how that works. Mutual funds, there's a lot of challenges in how they work structurally just because of the inflow and outflow. An index fund is, if you think of like a mutual fund, that is more fixed, right? So there's a manager still, but they're not really buying and selling based on what they think the best ones are. They're just
to the index, that
chasing an index, if you want to think of it that way. So an S&P index fund, it's meant to try to mirror that index.
Yeah. Okay.
So because of that, fees are generally lower because the manager is really not active inside that fund.
Gotcha. And there's so many indexes, it's picking an index and it's just going with it.
Exactly.
Yeah. Okay. And then a target date fund is a lot of us are probably familiar with that because we often pick that when we're first signing up at work or whatever the case is for our retirement date. Maybe you're in a 2030 or a 2040 fund. Mm-hmm.
Well, and target dates have become, you mentioned 401ks, more kind of that default investment option. Mm-hmm. So if you don't know what to pick, they're going to put you into a target date fund based on your age. If you look at the plan documents, it'll tell you, if here's your ages, this is the target date they're going to put you in. Target date funds, to me, they're kind of dangerous because you really have to understand what's going on. I mean, most people think of, a 2022 target date fund. So I'm retiring this year. Well, that's got to be a conservative fund.
Right.
Not really.
No.
I mean, it's about a 60-40 allocation typically.
They pretty much max out
at target.
Yeah, they max out at 50-50 is what I heard. The lowest that someone goes.
Yep. And then as it starts to as you age, right? So you get beyond that target date, it does start to move more towards the bond allocation. Mm-hmm. But yeah, you're never going to get down to 90%
risk.
Bond. Right. Exactly. I mean, it always has an equity component. And that being said, too, kind of playing back to our discussion on bonds, bonds with interest rates rising today, is that really a safe bet inside, safe side of that target date fund?
Well, it's the automation of it. It's what it sounds like, Phil, is that we've made so many automated things, and that's fine and dandy when the system is kind of keeping with the norm. But everything we've experienced the last, maybe 12 years or whatever, is almost outside the norm, right? So
yeah, you get in a more normal market, a target date fund generally kind of works, I mean, but it comes back to, do you want to guess at retirement or do you want to have an actual plan? A target date is, to me, a guess. I just want to do it easy, set it and forget it. It's going to adjust as I age. And it does.
If that's the minimum you're willing to put in, then at least you're doing that, right?
Right, exactly. Versus just throwing it in an S&P fund, do that. At least there's some adjustments for it.
Or the coffee can in the backyard, one of the two.
Or the coffee can in the backyard, right? Yeah. Okay. But you just understand the risk that's in there. That's my biggest concern with target date funds. I think people way underestimate the risk that's inside a target date fund.
Gotcha. Well, we're going to wrap this up this week because we don't want to make this one too long. We're going to drag some of this conversation about jargon into the next show. So again, we went through a bunch of the big pieces that tend to be going on right now because of all the things that we're seeing, because we are seeing volatility and we are seeing people, concerned with their risk tolerance and are we in a bear, are we in a bull, and all the things we've kind of covered on this episode. So what we're going to do is we're going to talk on the next episode, the next podcast, about how that relates with your advisor, their designations, what you're looking for in a potential advisor, and what some of these terms and things mean to them. So stick around, check that out when we come back in next week on the next show. If you're not subscribed to us, consider doing so on Apple, Google, Spotify, YouTube, whatever platform you like to use. You can find it all at philstaxhacks.com. Phil, thanks for hanging out, my friend, and explaining some of this stuff. I'll see you in a week.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.